name is Kamal Arif bin Karazan. My Westreet number is 2411605. My group will present about Westreet Resources Sdn Bhd. First, let's look at the company structure. Westreet is a fully integrated farm to fork food enterprise. This means they oversee every step of the process from growing, produce, and raising livestock on their agro farm to sorting and packaging at their integrated distribution center, all the way to producing ready-to-eat and ready-to-cook meals in their F&B division. This vertical integration gives Westreet strong control over quality, freshness, and supply chain reliability. Geographically, Westreet is strategically positioned. Their corporate headquarters in Bukit Damansara place them at the heart of Kuala Lumpur. Westreet integrated model provides a strong foundation, but to grow in a competitive market, the company must address key challenges proactively. First, Westreet should shift from competing on price to competing on value. By emphasizing strengths in halal certification, food safety, the company can reduce their client price sensitivity. Second, they should break the perception of factory food as generic through product differentiation, introducing menu rotations, healthier options, and dim culinary days would make their service more engaging and tailored. Third, to protect profitability, strengthening their internal cost structure is essential. This can be achieved through bulk purchasing and labor optimization to improve efficiency. And fourth, to manage the risk of rising raw material costs, proactively measures and recommend. This includes securing long-term supplier agreements and incorporating flexible price adjustment clauses in client contracts. Guiding all these efforts should be one fundamental principle: a relentless client-centric approach. Westreet should focus on deeply understanding each client needs and, above all, delivering unwavering consistency in every meal served. This consistency will build lasting trust and secure long-term partnership.
My name is Muhammad Zul Abro, 2412499. So, despite I will examine the weighted average cost of capital for Westreet Resources Sdn Bhd. WSCC represents the firm's overall cost of capital from equity and debt and serve as the minimum return required for investment to create value. Westreet was initially funded with 700,000 in honest equity and currently has no debt. To finance expansion, the company plans to obtain 5 million term loan from Agrobank at 6.9, increasing total capital to 5.7 million. The after-tax cost of debt is calculated by adjusting for Malaysia 24% corporate tax rate, resulting in 5.24%. The cost of equity reflecting the honest opportunity cost is benchmarked against RHB Smart Account 6.85%. Based on the new capital structure, equity weighted is 12.28%, debt weighted 87.72%. Using the WSCC formula, Westreet WSCC is 5.41%. This rate represents the company's hurdle rate. Any future project must generate return above 5.41% to add value to the firm. The high proportion of debt lower WSCC due to tax benefit, but investment discipline remains essential. In conclusion, the 5.41% of WSCC provide a clear benchmark for evaluating investment decision and ensure long-term value creation.
Assalamualaikum warahmatullahi wabarakatuh. My name is Putri Baitus Patricia Fatimah Rustam, and my metric card number is 2414354. So today I'm going to present to you about business valuation process. First thing first is define valuation purpose, which tells why the valuation needs to be conducted. There are some of the reasons. And then the next one is information gathering, which tells about financial and operational data. And also the next one is business analysis, which can understand how the company creates value. And then select valuation methods, which have three different approach. The first one is income-based approach, market-based approach, and also asset-based approach. And then the next one is valuation calculations, which is how these three approach needs to be calculated, and then review and adjust results. So basically, it compares value from different methods and also tells the company how to adjust it by the review. And then final report, the company have to present formal report. And then we move on to business evaluation method, which are three methods, which is income-based valuation, market-based valuation, and asset-based valuation. So basically, the first one is income-based valuation, which also say as ECF. It focuses more on future cash flows, and it is also suitable for Westreet Resources, which is an ongoing business. And it also has limitation, which is highly depends on assumptions. And the next one is market-based valuation, which will compare the company with other similar companies. And then it also has limitations, like it will require reliable and comparable data. And for the next one is asset-based valuation, which will value each of the company's assets and liabilities. It is very suitable for asset-heavy companies, and the limitation is ignores future earning potential. That's all from me.
Assalamualaikum, my name is Muhammad Irfan Daniel, my metric number 2418339. And now we are looking at a strategic expansion project for Westreet Resources Sdn Bhd. To meet increasing market demand, the company is considering a significant investment in a new manufacturing equipment aimed at boosting our overall production capacity. To ensure this is a sound financial decision, we have gathered comprehensive data and set clear assumptions for our 5-year outlook. First, let's break down the initial investment requirements. The project requires a new manufacturing unit with an upfront cost of RM200,000. We expect to sell this machinery for approximately RM25,000 at the end of the 5-year terms. For tax and accounting purposes, the equipment will be depreciated over 5 years using the straight line method. A key efficiency here is that we will use our existing facility, meaning no additional rental or facility costs are required for the expansion. And beyond the machinery, we must account for liquidity. We are budgeting an initial increase of RM30,000 in the net working capital to support the expanded operation. This capital will be fully recovered at the end of year 5. Our financial model applies a corporate tax rate of 24%. Crucially, we are benchmarking this project against a weighted average cost of capital (WACC) of 5.41%.
Finally, let's look at the bottom line. The actual cash flow, we start with the total initial investment of RM230,000 covering both equipment and working capital. Our operating cash flow stay positive throughout the project, starting from RM74,518 in the first year and climbing to RM207,618 by year 5. This figure includes adjustment for non-cash depreciation, and tax, providing us with the net cash flow needed for our final MPV and IRR analysis. Now, let's look at the broader impact on our income statement over the next 5 years. We are projecting a steady 20% annual revenue growth. We start from a base of RM1.71 million, and thanks to this expansion, we expect to cross the RM4,255,027 marked by year 5. This is driven by increased volume from major clients like Honda Malaysia and Produa. While revenue grows at 20%, we manage our operating expense to grow at a slower rate of 50%. You will notice that our gross profit more than doubles, moving from 513,000 in year 1 to 1,348,509 in year 5. This confirms that the project is not just increased sale, but significantly improving our profit margin through economy of scale.
Turning to the statement of financial position, we see a very healthy strengthening of our asset base. In year 1, our PPE jumps to RM250,000 to reflect the new machinery. We are diligently reducing this with a 46,000 annual accumulated depreciation, which keep our net book value realistic. One of the highlights of this forecast is our cash position. Even after the initial RM230,000 outlay, our cash and bank balances grow consistently, projected to reach over RM1.15 million by year 5. We are maintaining a balanced approach to current assets. Our trade receivable and inventory are scaling in line with our sales growth, ensuring that our operation remain liquid and we can meet all short-term obligations as they fall due.
Assalamualaikum warahmatullahi wabarakatuh. My name is Putri Shazina and my number matric is 2416008. The method used to compute the value of Westreet resources in the Berhad is the discounted cash flow approach. This method is used because it forecasts the future cash flow that are expected to be generated by the business. The discounted cash flow method is considered reliable as it incorporates the time value of money and is suitable for long-term analysis. The discount rate applied is based on the company weighted average cost of capital, which is 5.41%. After calculating the 5-year forecasted cash flow, the net present value is positive at RM326,000. This indicates that the initial investment is expected to generate sufficient future returns. Therefore, the project should be accepted as it is expected to enhance shareholder wealth. The internal rate of return is calculated to evaluate the profitability of the investment. This method is used because it considers the time value of money and assists in investment decision making. The result shows that the project generates an IRR of 29.94%. Since the internal rate return exceeds the company weighted average cost of capital, the project should be accepted.
Hello, Assalamualaikum. I am Nazara binti Mak Azli. My number matric is 2413982. So I will present about payback period, which is the years needed for the business to recover their initial investment. So based on our business, our initial investment is RM250,000. So our cumulative cash flow is up to years 2 only because it is the only amount that does not exceed the initial investment. But in year 3, we have to proportion the amount because we need to know the exact amount needed that can recover the initial investment. So based on our value computation, we managed to get 2.5 years for our business to recover the initial investment. Thank you. Okay, lastly, for conclusion, our business uses 3 methods, which is income-based approach, market-based approach, and asset-based approach. And for all the computation, which the discounted factor using the WACC rate, which is 5.41%, the results show positive NPV, IRR exceeding the cost of capital, and acceptable payback period, showing that the business is financially stable. Okay, that's all from us. Thank you.